Well, hello everyone. This is Andrew Hart coming at you from BigTrends.com, and just want to welcome you here today. We're going to be talking about yet another indicator for the indicator library. Today we'll be specifically talking about the Force Index, and of course the Force Index was created by our friend Dr. Alexander Elder, who many of you may or not know that we have had here at Big Trends many times for webinars and different presentations delivered to you as a free service. So if you haven't caught those in the past, then feel free to give us a call at any point in time, and we'd be more than willing to make that archive available to you. He's a wonderful man and a very good trader. So today we'll be learning about what is our favorite indicator that he's created. Okay, so first off, as you guys do know, access to Big Trends and its coaching services is provided for educational and informational purposes only. The information presented here does not constitute a recommendation to buy or sell a particular investment. You are solely responsible for your investment decisions, and Big Trends and its staff are not responsible for any trades you choose to make. Not all Big Trends products or services are appropriate for all investors. Big Trends does not provide personalized financial, tax, or legal advice. So please consult your tax consultant prior to making any investments that may impact your tax situation. Okay, first off, a little background on the Force Index. One of my favorite indicators, and actually it's bar none my favorite indicator when talking about volume. So just to give you a little idea of what we're going to be talking about today, so many of our indicators that we've looked at thus far, and so many that we'll continue to look at on into the future as you continue to watch the indicator library courses, are based solely upon, let's say, momentum, but basically just the sole price action. And of course then off of that we develop different systems based on those price action, whatever the indicator which is derived from the price action. So today we're going to be learning something new, and this is obviously based on volume, but just really very quickly here, the obviously, as I said, it was created by Alexander Elder, and also if you haven't seen any of his webinars here with us at Big Trends, feel free to give us a call. We'll make that archive available. But essentially, if you've heard of him before, he's probably most famous for his book Trading for a Living, which of course is targeted at those retail investors that were looking to become career traders, those that were looking to work from home. And it's a very, very great book, well laid out, and of course very well done. You also may know him from Coming to My Trading Room, and finally his most recent Entry and Exits. All very good books. Would recommend them for your weekend reads in between your trading days, and so on and so forth. But basically the Force Index relates price to volume. So it's kind of what? When you think about volume, what are you looking at? Well, you're looking obviously at inflows and outflows. If the price is going higher today and there's a lot of volume, there's a large inflow into that, say, mutual fund, into that stock, so on and so forth. So the Force Index is, when you break it all down, is more or less a money flow indicator, right? It's telling you about the flow of the money. The formula itself is very, very easy. You may not even have to write this down. You can walk away and this will all be tucked inside your brain very, very solidly. So basically, what is the Force Index? Now, when we get to it on, if you've never seen it on actually a chart, it's essentially two lines that oscillate around the zero line. And you've probably, that probably rings a bell from the perspective of there's other indicators that do that. But bottom line, these two lines are moving averages of a calculation. Those two lines that we'll see on the chart are two moving averages of what this is right here. Today's volume, whatever today, if you're looking at an hourly bar, it's really that hour's bar. So it should be that bar's volume times the net change in today's, or in that bar's price action. So if we're looking at a daily chart, think of it this way. Today's volume, let's say volume is 1 million, and today's net change is $3, which is 1%, let's say. So basically, if that 1 million volume is higher than average, well then guess what's going to happen? you're weighting the price action move of that day, positive or negative, with you're weighting it based on the volume, the relative volume. So if it's a weaker volume, but it's a higher, it's a gain on any given day, guess what? That gain loses significance because there's no volume backing it up. So for those of you out there that love looking and following those volume, the volume information data out there, there's a number of places to watch different large institutional trades, or just watching spikes in volume that clearly ring a bell that there's something going on. This is a great way to capture that at the same point in time, automatically relating that to the price action. So very, very useful. And as I said there earlier, most commonly used to determine the flow of money, right? Is it bullish or bearish? And basically that's what we got there. So now let's go to the next one, and let's talk about really how you would start to use this. Now there's really two different types of the force index that we use here at Big Trends. There's the short term and the long term. Now some people get confused on this, so listen carefully. The short term, which we're going to cover first, is what? Well, it doesn't matter if you're looking at daily, weekly. You don't look at longer term charts for a longer term force index. Where basically what the short term and long term indicate are the length of the two moving averages. So remember, what did I say about the calculation we saw, which was today's volume times the net difference in price action? That's the value that you get. Well, then the force index itself is basically two moving averages, one fast, one fast and one faster, or one slow, one slower. But basically, you've got two moving averages that you're looking at based on that difference. So the actual difference itself, not necessarily important. We're actually really looking at those two moving averages, because guess what? That difference is going to be a fairly sensitive line. So if you were to look at that just strictly, you're going to get probably prone to a lot of whipsaws. So we look at the two moving averages of that. Short term, as I have circled or square in a square box right there at your top left, is the 14 bar and 28 bar exponential moving average. So if we're looking at the 14 and 28 bar on a buy signal, what are we looking for? Just like all these other indicators, whether it's from the stochastics or whether it's all the way down to let's think of the many other ones. I mean, you can think of the DMI difference when you can apply two different moving averages to that. You're always going to be looking for the short-term moving average to cross the longer term, right? Because it's going to be the one that picks up the shorter-term momentum or the shorter-term action that gets you on it faster, gets you out of it faster. The 28 bar, or in this case the longer-term bar, is what's going to give you that stability, that thing that's going to help you stay in. So that's why you use two different lengths. So when the 14 bar line crosses above the 28 bar, what is that? It's a bullish setup. Exactly. If there's one thing you've learned here on a constant basis over and over and over, it's that you can't just play these crosses in moving averages, crosses in different indicators. You've got to implement some sort of confirmations. Pardon me. Those the confirmation on the force index is just going to be as simple as other confirmations we've used. That setup, which is the cross day or the cross bars high, right? Because now that we have that bullish cross, we want a confirmation that confirms what we already believe. Once it crosses that, the 14 bar crosses above the 28 bar line, we believe this is a bullish setup. So we need to see it close above that bar's high, right? Remember, any confirmation we want to see within a certain time limit. Most often you'll hear us talk about 5 bars, so that's what we're going to apply here. Why? It needs to be timely. If it, obviously if you just leave something open, anything can happen, and you need to